Okay, so let's go ahead. Hello, everyone, and welcome for the new session of the EDHEC Virtual Speaker Series on the Future of Finance. I'm Emmanuel Josenko. I'm the Director of Graduate Finance Program here at EDHEC Business School. And it's my pleasure to welcome you today. So I want first to introduce our co-moderators for today's session. So we have my colleague, Professor Laurent Calvet. Laurent, which is one of our main experts on empirical asset pricing at EDHEC. We have also Marianne Cheng, that is a student in the MSc in Corporate Finance and Banking. And it's my pleasure to introduce our guest speaker for today's session, so William Gottsman. So Will is a professor of finance and faculty director of the International Center of Finance at the Yale School of Management. So Will is an internationally renowned financial economist, has published scholarly articles on so many various topics, difficult for me to summarize them, but I will just mention stock market predictability, hedge fund performance, real estate, private equity, alternative assets. We'll also have written and co-authored a number of reference textbooks, including, for instance, Modern Portfolio Theory and Investment Analysis, Money Changed Everything, one of his last book, How Finance Made Civilization. And we are very fortunate to have him speak today about NFTs, so non-fungible tokens, as perhaps the future investment class. So without further ado, Will, I will welcome you and give you the virtual floor. The virtual floor is yours. Will?
Well, thank you very much. It's a pleasure to be here and to be speaking with you. I'm looking forward to the questions and discussion. Let me preface this before I show my slides with a little bit of background. I thought that when I was young, I was going to be an artist. And so my life was focused on the arts, and you can see from my office that it still has somewhat of that focus. But when I made a transition to economics and finance, I wanted to have something to bring with me from my prior interests in life. And so that got me started on a career of exploring art as an asset. So the talk today is going to be about, quite broadly, how art serves and can serve as an asset. And you'll see also why it interests me as an economist. Let me now share my screen. We use this term passion asset. And you can imagine many different things that people can get passionate about, everything from works of art and beautiful houses to ESG assets and things that are designed to change the world. But we're going to focus on collectibles today. So I like history as well. So I'm going to start back into deep back into time. And these are little stones that archaeologists found in a cave in what's now Israel. It's called Kesem Cave, and it's one of the earliest human habitation sites in the Mediterranean area. And archaeologists began to find these little interesting, colorful pebbles in this cave. Where the occupants they predated Homo sapiens. And why were the pebbles there? They couldn't have gotten washed in. Well, they were collector's items. Very clearly, people that lived in that cave would go pick up interesting stones, bring them in. For what reason, we don't know, except that you can see some of them are quite beautiful. So that notion of collecting beautiful things certainly extends back earlier than the history of of Homo sapiens. Here's a couple more that are particularly kind of cool. One of them is a pebble that somebody found in South Africa that is about the same age as those little stones I showed you before. It looks like a person. But the other one is a hand axe, coup de poing, I think it's called, which is it's a tool, but the tool is more than a tool because it's got a shell right in the middle of it. The ancient person that made that tool must have chosen it because and designed the tool around this idea of a shell in it. So you can see that this notion of making special things or collecting special things is quite embedded in the human psyche. As it must be as important in some sense, or almost as important as our economic incentives. So now I want to move on to what an economist will think about art. You'll see why I'm sort of interested in this area of research as well, because I like to think about collectibles in general as non-fungible assets. We call the new electronic non-fungible assets NFTs, but the difference between fungibility and non-fungibility is quite interesting when you start to think about valuing these things. What's the price of something like one of those beautifully made tools or something? So it's the difference in economic terms between assets that have a common value and are substitutable for each other, and private value assets where the specialness of the item in some sense may be more valuable to one person than the other. So this issue arises when you think about putting a price on a house, for example, whether one person likes to live in a house with a beautiful view, or another person likes to live in a house that's close to a park. Those are things that people have different views about. But even more than that, the notion of a unique asset, a non-fungible asset that has no perfect substitute, may actually be an endogenous feature of this market. People like to pick things that are special to them and represent their special tastes. So the person that picked out one of those beautiful red little pebbles might have chosen it because it was different than all the other pebbles. How do we think about that as economists? And then how do we actually build some measure of the value as an asset? That's what this has interested me for probably about 30 years and has provoked my research constantly to investigate. Some of my early research was really about how do you build an index of art over time so that we could compare it to stocks and bonds and other kinds of assets. Here's a picture of a work that I did with Christoph Spaniers and Luc Rimbouk, which is an index of the capital appreciation of a portfolio of art from 1765 up to 2005. I haven't extended it further because it's harder and harder to get this data. But when you look at it, you can see a few interesting things. The most important for an investor is this index goes up on average. And when you correct for inflation, it still goes up more than inflation. The other thing to look at is what happens around these periods of that we know to be difficult times in history. The First World War, the art went down a lot, and the crash of 1929, the art went down. In the United States, and in Britain certainly too, 1973 was a terrible year for the stock market. Art went down there, and then even in 1990, there was a bubble in tech stocks that burst, and so you can see, art may be something that doesn't generate dividends. It may be something very different than productive assets in the economy, but for some interesting reason, it seems to actually move very broadly with measures of other asset values. So what, the natural thing, if you're a financial economist, let's look at the beta of art. And so I've put in a measure that uses I put in a measure of the UK stock index, just the index without the dividends, just to give you a picture of how art and stocks actually had a positive correlation over the period 1830 to 2005. And the beta that we have estimated from this relationship is 0.4. So if somebody says, what is the expected return to art? If it was efficiently priced, you wouldn't expect it to match the stock market. You'd expect it to have a somewhat less return. When we compare art, the return of art, to at least without transactions costs and so forth, to the return of stocks plus dividends, you can see that the rate of return is significantly lower than investing in the stock market, at least over the long term. So that's another lesson that we were able to learn when we looked at the historical rates of return. Another thing that's kind of interesting is, and this may be because art has some role in society beyond its value as an asset, of course. It may be a signifier of wealth. It could be something that distinguishes somebody as a great connoisseur. But with Christophe Spaniers and Luc Renneboog, we tested whether there was a relationship between income inequality and those art returns, that the performance of art that you saw in the previous picture. We took the income inequality measures from Thomas Piketty, and we were able to identify a positive relationship between the change in inequality and the return to investing in art. So whenever you see a box with some numbers and 3 stars, you can tell an economist is excited about a result that is statistically significant. So part of the research into art that has kept me fascinated is, what are the broader social roles that art plays, and why are people willing to spend money on that dimension as well? Okay, I promised a little bit of further information about valuation. I think what I'd like to show you is the complexity involved in trying to value a single work of art, and a little bit of a sense of how we estimate risk and return. Here's a painting by Joan Mitchell, a wonderful abstract expressionist painter. She actually did a lot of her work in the south of France. And her work currently sells for a lot of money. And here is a picture that was painted in 1989. And it came up for auction. And the problem the auctioneers have is, how do you put a price on this thing? Well, I've done some work on that as well, both in practice and also in academic research. And I will tell you, the most important thing is, the most important determinant of the value is the identity of the artist. So knowing it's a Joan Mitchell painting tells you a lot about whether it's $1 million painting or a $100 painting. And you might not be able to tell that by looking at the art, right? The importance of the work in the artist's own oeuvre, and of course, whether or not it is actually painted by the artist, those are things that are essential to the valuation. But when it comes down to it, since this is a unique work of art, we have to use something like comparable sales, but there's no perfect comparison. So what do? We actually use a linear regression for this, and it's a regression that is called a hedonic regression, because we can represent the characteristics of this work of art by X variables, And it's a quite general framework for doing this estimation. But what we need are past sales of Joan Mitchell's art. That's the data that we have to run the regression. So if you're ever thinking about doing this, there are databases, and I've told you down at the bottom where you can access these data. There are databases where you can get all of the past auction sales, and you can even get pictures of the works of art. And then you can see all of these have potential to be the hedonic characteristics that you would put into a regression. For example, if you look at the year, some of the, you may not be able to see it well enough, but there's some of the paintings that were painted in the 1950s that were earlier in her work, and then some later. So the 1989, that was a bit late for Joan Mitchell. Then the other variables are the width of the painting and the height of the painting. Of course, we also have the date that the painting sold. So when was it auctioned? And then we also have the estimates that the auction house itself placed on these paintings. And then finally, we have the actual price that the painting sold for. So we're going to try and explain the actual price of those paintings by these characteristics. And then we can use the characteristics of the Joan Mitchell painting that we're interested in to estimate the value. Once we build a model with our regression, we just put in the characteristics that we're interested in estimating. So the next slide is the result of that regression. First of all, do we have a good model? And what is the model? Well, I just chopped down the model, the variables down to the width of the painting and the height of the painting. And then how many years, what the number of years in the past that the painting was painted. And then I also have I put a 1 in each one of a series of columns for each one of the years that the auctions were observed. So that's what these are. These are called year dummies. And that's because, sometimes the whole art market is up in that year or it's down. So you can see some of these year dummies, like 2016, there was a big positive coefficient on this year, meaning it's probably a good year for art. Then we have our t-statistic to tell us whether or not these things are significant. Now, every single time I've ever run a hedonic regression with art, it has told me that the size matters. So once you know who the artist is, then you need know how big this is, and you probably also need to know whether it's an oil or not. So you can see the wider the painting, the more valuable. And then the earlier the painting is in her work, the more valuable it is too. So that's how we go through and try and estimate the value of a work of art. Now look at this, the standard error is huge. So the model predicts that this painting could sell for between 5 million, 5.8 million and 1.6 million. That's a very big range. So if you are investing in art, you trust the statistical analysis, take this uncertainty seriously. It's big risk about what you can resell your art for. The actual painting, by the way, sold for $3.75 million. And the estimate by the auction house was not as broad as our estimate statistically. Okay, now I want to talk about my current research. This is a picture from Tulip Mania from the 17th century in the Netherlands, when people were spending an enormous amount of money buying crazy things, tulip bulbs. And it's the most famous bubble in all of financial history. Well, we all have had the opportunity to live through one of the most extraordinary bubbles in assets in centuries, which is NFTs, non-fungible tokens. You can judge, actually, when I show you the evidence about these, whether it's an extraordinary bubble, but it's very similar to the tulip bubble because it's not really a main financial asset, but it's a work of art. It's a special non-fungible thing that suddenly shot up in value. I'll show you some NFTs just to give you a sense of what they look like. I showed you the pebbles before. Now I'm showing you these NFTs that are the modern versions that people collect, these little items. One of them is actually a AI generated portrait, which is kind of cool. But think how much money you would pay for one of those. Now look at the price that somebody else paid for one. $3.3 thousand, $27,000, 0.27. Here's 5.2 thousand. So people are paying thousands of dollars for these things. And now these are the most famous. They're called CryptoPunks. And now look at the millions of dollars that these things were selling for in 2021. $7.58 million for that little thing. And it's not physical, by the way. It's just an electronic file that anybody can. I've got it right here. I can look at it anytime I want. So with some co-authors, Dong Huang and Milad Nozari, we have been investigating this bubble. And so I can show you, for example, in dollar terms, which is the black line, the price in dollars, if you bought something for $1,000, you'd say, well, the index, it looks like $1,000 investment may have gone up to $5 million. Okay, that's the kind of excitement that people had about this. From 2018, it was kind of flat. And then all of a sudden in 2020, people started to get interested in these NFTs. The price started going up. And then in 2021, it was spiking. And then it looked like it still was going up towards the early 2022. That's what these simple indexes of the median values seem to be showing. Okay, actually, those are the max values. The median values are a little bit more modest, but they do show you that they suggest that these things were high towards the end. But we really had our doubts about this. The doubts are based on the hope that people had that what they bought in 2018 was really going to keep going up. So these are the asking prices, actually the seller reserve that we look at asking prices for what people, once they bought an NFT, what do they try and sell it for? And what you see is that on average, they buy it for they want to sell it for 6 times the price that they bought it. So imagine buying a house and then putting a price tag on the house that's 6 times higher. That it seems crazy, but sometimes people were getting those extreme prices. That is the thing that can really generate a bubble. This kind of expectations that seem to be fulfilled, and people just keep buying. Even they just keep on asking and bidding these things up. So what we noticed, however, is that towards the end of this time period, these NFTs were not selling. Liquidity is really an important issue here. And so look at the green line versus the black line. Now, I'm not going to go into the complexities of how we did this, but I will tell you the general econometric issue that we got interested in is how do you correct for the fact that even though there are a few sales that are high enough to exceed that 6 times original price, if you're only using those to create your index, you're almost certainly overestimating the value of all the things that didn't sell in that same time period. How do you correct for that? Well, we have models in econometrics to correct for that kind of selection bias. And with advanced techniques of optimization and kind of an Bayesian approach, we're able to construct a selection corrected index. So what you can see here is the selection corrected index in the green follows a different path than the uncorrected index, which we're calling a repeat sale index. And you notice that the uncorrected index grows by a very high number, sort of 5,000, from 100, roughly 100 to 5,000. But the green index, once you correct for that, grows by much less. And in fact, what you see is there's a big crash in early 2021 that was not observed when you looked at just the things that sold only. Once you take into account the fact that things didn't sell, there's a big difference. So if you're an investor, what does this mean? Well, first of all, it's not going to help me to tell you that when liquidity dries up, try and sell your assets, because you can't do it. But it's important to know that if you're investing in a non-fungible asset, those markets can dry up. You have to consider that risk. So now I'm going to show you a bit more about what if we simulated an investment strategy based upon the NFTs that sold over that time period, 2018 to the present, or at least till early 2022. We can do that because there's fantastic data about NFTs. So we can see a purchase and a sale price. And so what we did is we asked ourselves, what if we were going to every month, we're going to buy NFTs, hypothetically buy the NFTs by the most liquid artists, liquid creators of NFTs, and then hold them. And then we will realize the sale when those things sold again. Well, first of all, most of those NFTs, most of those artists didn't really generate any profits. The only profits really were coming from the last 10% of the artists, and really the high profits were just 1 or 2 artists. So it's very much a superstar market, just like a venture market, venture capital. You'd have to invest in a lot of these things in order to be sure you're going to make some money. So next, we're going to look at liquidity. And let me just show you this one picture, which is a measure of the probability of probability of resale. In other words, let's say that you bought an NFT in our sample, and then you want to know what was the time until it was resold. Well, that's what this chart is. It's a survival curve that people use for medical purposes to see what's the expected lifespan of people. And the half-life is at the 50% mark. And this says 50% of these NFTs were resold within about 120 days. So it's not like they were able to be resold quickly. It takes a long time for this, for you to expect that you could resell it. As a matter of fact, it takes, you still you still are stuck with about 30% of your NFTs after 2 or 3 years of holding on to them. So like in private equity, you're not always able to sell the companies that your private equity firm has bought in a timely fashion. And finally, this is the most interesting one. Out of about 4,000, actually more than 4,000 repeated sales where we can measure the returns, we started dropping out the highest returning transactions. And we found that after we dropped out just a little more than the top 200 transactions out of all the 4,000 some odd transactions, after 200, your internal rate of return, which is on this axis, goes down to 0. So again, just a handful, only 5% or so of these NFT transactions were driving the whole level of profits. I'll leave you with a little bit more on the institutional side. Up until recently, you probably, if you're interested in NFTs, you would see that people were suddenly creating investment portfolios from them, using them to back new products. And then a whole new marketplace has also evolved for you to buy regular works of art. I would say what I've just showed you about the illiquidity and about the bias in what the historical rates of return might be should give you some caution about jumping into this interesting, volatile, and unusual kind of markets of NFTs, and for that matter, also into the art market. So I will stop here. Just wanted to give you a very quick overview of things that I've worked on in the past and things that are exciting to me now about non-fungible assets.
Okay, thank you very much, Will. Thanks for this great presentation and I would say hot topic. So now I'm passing to Laurent. So Laurent, if you want to say a few words or ask any questions about the topic and the presentation of Will.
Yes, well, thank you, Emmanuel, for giving me the opportunity to catch up with Will really after so many years. So just before the webinar started, we were reminiscing that the first time we met was over a paper that I had co-authored with Benoit Mandelbrot and Adlai Fischer. And so it was a paper about the application of multifractals to finance. And in some sense, fractals, I think the success of fractals comes from the fact that they are beautiful, right? They are ways of generating very nice works of art. So now I see that we've transitioned from fractals to NFTs. And my question really is about the quality of art. So clearly, when you look at old paintings, there's no feedback, I would say, between the innovations that we see in the art market, and the quality of the work that Van Gogh or others have done. But in the old days, like Van Gogh, was a poor, lived poor, died poor. And now we have all these financial activities or this financialization of art. So I was wondering if there was a feedback loop and this in some way affected the quality of the art that's produced. So that was the one question.
Yes, that's an important question. And also a question about the role of the art in society as opposed to simply as an asset. But you're asking also about the feedback of the market back into the production of the art. There was a sale in early 2021 by an artist who's known as Beeple for $69 million at auction, which it's an electronic work of art, and Mike Winkelmann is the man's real name. And that transformed the marketplace and expectations about the value. But also Mike Winkelmann's art is, it's, I would say, surrealistic, contemporary techno-surrealism. where he will create fantastic creatures in a peculiar science fiction-y landscape. His art, that kind of characterizes a lot of NFT art because Winckelmann was a computer scientist before he became an artist, or actually he's always been both. But you know, that's a particular subculture in our society. And his art appealed to that group first before appealing to the fine art. This auction was important because it was clearly an attempt by the major auction houses, Sotheby's and Christie's and so on, to get their customers involved in this new art form. And for them to get involved in the new art form, they had to develop a whole new set of tastes, which probably isn't unusual because every weird new contemporary work of art, a collector had to already adjust their mind around these things. So this art world at the very high end is adjusting. Meanwhile, artists that were making things like Mike Winckelmann said, well, this is great. There's a chance for me to become a multimillionaire. So he's showed us what sells. So let's move in that direction. And, you know, this is just it was just a year or two, over the last 2 years, it's been people trying to figure out, will there really be a high-end collectible market? How do I redefine myself so that Winckelmann's customers will buy my art? And then amidst all of this, artists who really never have had a chance to get top galleries, they see this as a new medium for them to be able to reach directly to an audience. And also, you saw those motion things. It's a new medium for them to explore their expression as well. So we don't have any idea where it's all going to come down. But the problem with any kind of collectibles market is if there are too many people that are speculating and not appreciating the works of art, then when they dumped all their NFTs, what's the final set of collectors that really love these things? And are they does it expand beyond the kind of techno computer-oriented clientele that it started with? And we don't know that yet.
Oh, yeah, exactly. I have another question. I mean, you showed that in NFT markets, right, very few works of art make it above a threshold. I think it was $25,000. In the more traditional art market, it's very common to bump up prices. So you have a ring of dealers, and they identify an artist, they decide to pump up the price by buying and selling, the paintings in different auction houses, and then collectors notice that the values goes up. I mean, is there room for pumping up prices in these new NFT markets?
Oh, absolutely. That's been one of the concerns. Even I'm sure in my data set, there must be some examples of people secretly bidding their own works of art up to high values. So the Securities and Exchange Commission is interested in this. The regulators are interested in whether or not there's price manipulation. Once you're talking about millions of dollars, they're going to be very attentive to whether or not there's price manipulation. And so that's a concern, not only for people trying to estimate, for us trying to estimate returns, but also that's a risk that you face when you're playing in this market and you're not, you don't know whether your counterparties are honest. So that's a big issue.
Yes. Well, okay, that's what I thought as well. But thank you for confirming it. Maybe you have one last question before Marianne takes over. So you mentioned that there is a link between the returns on art and income inequality. And I noticed in particular that it's income inequality. It's not the share of top income that shows up in your regression. I mean, can you comment maybe a little bit more on what you think as the underlying mechanisms, creating these correlations?
Yes. It's not particularly it's not in that paper. We talk about it a little bit, but the mechanism that we have in mind might be like a Thorsten Veblen effect, conspicuous consumption. I did some work with Sharon Oster, who I'm sure you remember Sharon from the economics group at the School of Management when you were here as a doctoral student. But she and I worked on the role of museums in cities. And we found that in cities where there was a sudden nouveau riche, that museums were supported by a lot of donations, suggesting that the museum had a social function to create a pecking order, a lexicographic ordering of people in the city. So that's one hypothesis that we had, that in terms when people are making a lot of money, there needs to be another signal besides simply wealth to differentiate differentiate somebody socially. So that was one idea at the back of our minds when we were running those tests about inequality. But it's hard to think of better tests about how to actually do that. By the way, you reminded me, of course, Benoit Mandelbrot was a pioneer in electronic art, because his fractals, he was showing us these pictures of mountains and clouds and landscapes, but they were all pixels. So exactly. He was very early ahead of his time. I wish we could have told him about NFTs, but a lot of them, I'm sure, use fractals actually to make them look more realistic.
Thank you very much for your answers.
And great to see you.
Yes, Marianne, I think, has questions for you.
Thank you, Laurent. So, Marianne.
Thank you again for this presentation. It was very interesting to learn more about patient assets and techniques used to value them. So you mentioned during your presentation the importance of artist identity when it comes to value on art. And I read that in 2018, Christie solved the first art made by artificial intelligence. And in this case, there were no human artists behind the painting, but only on the algorithm. And my question was, so do you think that in the wake of AI artwork, the importance of artist reputation in the valuation of the arts is called into question?
Well, that's a really interesting issue. It's been a few years since the very first AI work of art was sold. And if I remember correctly, it sold for quite a bit of money at an auction. It could be that was the case of the auction house trying to build out a new, try to instigate a new market. But I think it's going to depend on how beautiful and interesting these things are. They're getting more interesting visually every day. Just over the last few months, as we all begin to play with these tools, we find they make things that provoke your imagination. So I don't know whether it's going to be. I don't know what the value of them will be, because we don't know how unique each one of the images will truly be. If there's an artificial artist, how similar will the artworks be? Maybe we should treat the artificial artist as something or somebody that has to develop a reputation and an oeuvre to react to before we can evaluate. But the artificial artist is ultimately a programmer. So if I were the programmer, I would be taking credit for creating this this automaton.
Thank you. And I have a second question. So now in the wake of NFT, I'd like to know if the profile of the buyer of those NFT are the same of those who buy physical painting, or is there some difference?
We don't know that yet. We do know that there is kind of a jet set of art buyers that immediately felt compelled to invest in the latest thing. So there probably is some overlap in collectors. But I think in terms of the clientele that loves the work of art and has followed these artists for a long time, I think that it's fairly separated so far. And whether or not the tastes will develop, or even the social value of these NFTs will fill the same role, is open to question. You know, NFTs, collecting NFTs is a little bit like collecting picture books. You have to open up something and look at it. It's a personal experience. It's very hard to easily display them. Although Samsung has a new television that's designed to allow you to do that. But we don't know how you can show off these things. It's consumption, but will they be conspicuous consumption, and how? We don't understand that.
Thank you. And maybe one last question. So you've done a lot of analysis on art valuation and between physical painting and NFT. From your point of view, which is the best investment?
Well, I think I showed you that evidence that NFTs are extremely risky investments. Are they riskier than paintings? We know more about the long-term history of paintings, but you know, I tell you, if you go back to the 19th century and you say, I'm an art collector in the 19th century, what would I be buying? You probably would have been buying things like furniture and rugs. And so it could even be from our perspective that paintings turned out to be the medium for, you know, the whole revolution and abstraction and so forth. But maybe even paintings are just a temporary phenomena in the history of art. So I would still bet that paintings would be a long-term investment that will hold value compared to NFTs. But then again, you would like to believe that it's worth it to invest at least a little bit in the beginning of a new art form. If you could have been, if you could have spotted a Van Gogh in his brother's window when he was selling them and just bought a small one, yeah, it would have been a wise thing to do. So I keep my eye on those prices of those crypto punks, because if they ever completely collapse, I'm going to buy one because those are the icons of this bubble.
Thank you for the answer.
Thanks for the question.
Thank you, Marianne. So there were a couple of questions in the Q&A, one which is related to some from Marianne. My question is the following. What are your thoughts regarding NFTs representing and accompanying real art pieces like paintings or watches that are proposed at auctions like they did with NFT drawings of Gerald Janta watches? Mm-hmm.
Well, right now, even the auction market for NFTs is a bit fragmented. Even so, the major auction houses felt left out because the data we use is from an NFT auction house called Super Rare. So there's this competition about where the ultimate venue for these will be. And so the question being, will they accompany real art pieces or even collectibles like watches? I think that the auction houses are really trying hard to get them to be accepted as a category of collectible, and they're trying hard to establish themselves as the taste makers for what is the very top that you could buy, because the market is undifferentiated right now. There's no, even though Super Rare is for example, is a curated marketplace, it's not curated to only take things that sell for the 10,000s and 100,000s and so forth. So there will probably be, particularly if these NFTs have a social value, there will probably be a marketplace that is for the super rich. And so whose marketplace will that be? Will it be Christie's and Sotheby's and some of the other auction houses? We don't know yet, but I'm sure that's an issue for the strategists in that in these auction houses.
Thank you. From my side, I have a question with respect to, we're talking about tokenization of art, right? What are your views with respect to tokenization of other alternative assets like private equity, real estate? So what do you think about this movement, which basically try to digitalize the several alternative form of investments?
That masterworks.io website is trying to create a marketplace for fractional shares of works of art. And so you can imagine all sorts of challenges with that, like what's the valuation at any given time when you, but I think that that's a beginning of the creation of liquidity in works of art. Once you have some works of art that are worth millions of dollars, then of course securitization might make some sense. So I think we're going to move in that direction further. There will always be questions about the mechanisms, the valuations, and so forth, but those are all just risk issues. The one benefit, of course, is to tokenization, or at least some form of fractional ownership, is that the artists themselves can continue to participate in future sales. And that is what motivated it and particularly in Europe, but it's catching hold in other countries as well, I think.
So there were another question. Do you believe NFT's impact on the environment could lead to their downfall? Also, do you believe that NFTs can be sustainable? To what extent?
That's one of the most important questions, because for those of us in the world of finance and investments, the first question we get every day waking up in the morning is, what about ESG? And so how can you have an investment like an NFT if the electricity costs for the verification of the transactions every day is sort of equal to the electrical generation, the cost of electricity generated in a country like Belgium? I mean, I'm exaggerating because I don't know the actual numbers, but that has been a big issue. How can somebody brag about, how can somebody believe in NFTs if the transactions generate so much carbon? So many of the NFTs, all the NFTs that I showed you in the presentation traded in Ethereum. So Ethereum is, well, just within the last month, they transitioned to a new form of verification that they claim has cut down the carbon footprint by a factor of 100, I think, something like that. What that meant to me is suddenly you can feel a lot better about investing in something that uses the blockchain if it's the Ethereum blockchain. Now, whether or not they're correct in their description of the carbon footprint and so forth is I'll leave it to other people that study this. But I think all of the verification processes are going to have to move to a much smaller carbon footprint mechanism, and Ethereum was wise to do that now, and I think that will maintain its lead position in the NFT market.
Okay, so I don't see any other questions. So I don't know if Marianne or Laurent want to ask a last question. If not, I just want to thank to all our speakers. So thank you, Laurent, thank you, Marianne, and most importantly, thank you very much, Will, for this presentation of this new form of art investing. This was super interesting, and we look forward to read the final version of your research paper, because to my understanding, you are the start of the research process on that. So thanks. Before we close down, I just want to mention that we'll have a next session that will be on 15th of November, same day, same time, and we will continue our journey on the future of finance with Ronnie Satka from Boston College that will talk about some application on big data, investment application using media stats. So thank everybody, thank you, and see you soon. Thank you, Will. Great time with you, and hope to see you in Nice or in Switzerland for private markets conference. I'll see you, Will. Thanks to all. Thank you, Laurent. Thank you,
Thank you
Mariam.
very much. Thank you.
Thank you. I really enjoyed it. Appreciate your great questions, and liked spending time with you virtually here. So I also hope to see you in Nice.
Merci beaucoup, Will.
Merci.
Okay.
À
Thank you.
bientôt. Merci
Bye.
à tous. Bye bye.
Bye.